Hi guys, welcome to my channel. I'll be talking about market structure today. So I've noticed a lot of us these days have conflicted understanding of market structure. So it's just how you identify your trend, how you identify a range bound market and how you identify choppy market and when to stay away from them. Understanding market structure helps you with basically this. And if you have this foundation, it makes it very easy for you to go around with your multi-time frame analysis. So whether you are doing top down or bottom to top analysis, whatever you call it. So it's very important. Market structure is very important. So I'll start with the first one, which is trending market. And a lot of us want to be in the market when the market makers are making the move, when there's large moves, and most of us want to be out of the market when it's ranging. In fact, some of us don't like seeing retracement. When we see any form of retracement in the market, we just close our trade, causing us to maybe exit the trade too early and stuff like that. So understanding market structure can actually help with these things. So first of all, range market. So here is where you have series of higher highs and higher lows. So when you see a market typically creates a new high and retraces, which is inevitable. Markets will always retrace. No markets will just, travel straight to its to a resistance without retracing at some point. So when a retracement happens and the market creates a new high, you can refer to that market as being in a trend. If you open this that I have drawn on the screen, let's say it's on the daily time frame, and you open it on a lower time frame, like the 1 hour time frame, you are going to see that you have series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. Even while there is this temporary retracement on the daily time frame, the continuation is still going to be a continuation of higher highs, higher lows. And in the long run, you are going to see big moves like institutional candle. What I mean by institutional candle are those long candlesticks that, just creates this, it serves as where we have institutional buyers or institutional sellers, where we have large banks coming in. So you're going to find more of this type of candles when you open the lower time frame. You understand? So vice versa when you're talking about the downtrend, because for this is an uptrend. Under the trending market, we have the uptrend, we have the downtrend. So for the downtrend, when you see price making series of lower lows, lower highs, and then lower lows, lower highs, and then lower lows. When you see market making a series of lower lows and lower highs, same thing with the uptrend. So in the case of the downtrend, when you see market making a series of lower lows and lower highs, you know that it's a downtrend and you want to look in to buy and to sell rather. So in this case, when you have confirmed the trend with series of higher highs and higher lows, where you are actually making your entry matters a lot. So you want to be making entries around the exact spots where the institutions are coming in, the big banks are coming in. You want to be going with the move. You don't want to start making your purchase or buying your contracts when the move has almost ended. You understand? So you want to be coming in around levels associated with the anchor. So the anchor is the lower high or higher low before the break of the new structure. Here's the break of the new structure. Here's where you have the break of structure. So the anchor is always that lower high or higher low before the break of structure, which is before creating a lower low or before creating a higher high. I don't know. So if you don't understand this video, you can like pause and draw whatever it is you are hearing me saying, just for you to understand. Because I understand some people are like very practical, so they need to draw or to like properly sit and understand these things. You don't have to rush, because this is a concept that is very, very important for your foundation when it comes to trading. So on my next video, I'm going to be talking about how to make these entries. But since we are just talking about market structure, I want to like just explain what market structure is. I give an understanding of what it is. Secondly, I'll be discussing range bound market. So here is where we have series of equal highs. So if you trade ICT concepts, you're going to maybe you must have heard about mitigation, areas of liquidities and areas of possible mitigation. So what it means is price, or let me say institutions, buyers and sellers, are probably keeping the price at a particular level, causing the price to range. So in this case, you can see, at a point, the buyers are pushing, the sellers are pushing down, the buyers are pushing back up. So some people, depending on the strategy you trade, you are expected to avoid this kind of market. And some people, depending on the strategy you take, these are the kind of markets you look for, So what you want to be doing in this, sport is, in order for you to identify a range bound market, you need to understand what the trending market is. If you find out that price is not breaking the previous high to create a new high, and is constantly rejecting the previous high, then you know that you are probably experiencing a range bound market. That's what it means. And in a range bound market, there's something we call areas of liquidity, which is where we have most buyers or most sellers placing their stops before entries. So in this case, at the area of demand, which is the bottom, where we have most buyers, there's a liquidity area. That demand area is also a liquidity area where most of these buyers must have placed their stop loss in order to avoid big losses. So on the other hand, most of the sellers placed their stop loss right above their entries at the supply area. So those areas are areas of liquidity. Most of you must have wondered or experienced cases where price will just be ranging and all of a sudden it will just drop down, and take out the demand area. And you might think, oh, price has broken below the resistance, let me trade it, wait for a retracement. Instead of a retracement, price broke back into the range and continued ranging. So that is just the market makers or institutions taking out your stops. They know that those are areas of liquidity, and then they just want to take out buyers or sellers And then, so you need to be, wary of issues like this. You need to be very cautious. So when you have cases like this, depending on your backtested strategy, you need to work around the effect. On my next video, I'm going to be talking about how to utilize these setups and maybe create a strategy from them. So next, I'll be talking about lastly, which is the choppy market. So these types of markets are typically just chaotic. Like, they don't have a particular trend. They are not really ranging. They are just, they are just moving in a way that is not like ranging and not trending. So once you see this kind of market, it's very easy to identify. Once you see these types of markets, you just avoid them. That's the only thing you can do. There's no strategy that allows you to trade under this market condition. You're only going to get burnt. So I'll recap what I've just said. Ranging market, where we have areas of liquidity at the demand, areas of liquidity at the supply, buyers and sellers, institutions pushing price between the demand and supply, and being wary of these liquidity areas as your stop loss can get swept. So trending markets, where price consistently creates higher highs and higher lows, and your areas of entry should be focused on the anchors. So, and for choppy markets, they don't really have a direction and they are not ranging. So thank you very much. See you in my next video.